Our global stocks slid earlier as they wrap up a torrid first week of the third quarter of financial markets, with the dollar standing tall and bonds crumbling as the resilience of U.S. jobs data has investors bracing for interest rates heading higher. However, the rand hovered around its previous close against the dollar in early trade after falling almost 2% the previous day amid risk-averse markets. SABC markets anchor Nastassia Arendse reviewed the first half of the year with the independent analyst, the finance ghost. Take a look.
I did expect a pretty flat year for equities. The rising rate cycle has obviously been causing a lot of pain. You know, it robs equities of returns because it makes debt more expensive, so the banks get a greater share of the profits that a business is making. And it also increases the required rate of return for investors, and that puts share prices under pressure. So in terms of what I did expect, you know, year to date, the top 40 is up roughly 1%. It's been on a wild ride, though. Lots and lots of volatility. I wasn't expecting load shedding to do what it did, and obviously that drove an enormous sort of sell-off and then a bit of a resurgence in some of the stocks. But ultimately, it's been, you know, if you just bought in January and you held until today, you've actually not really gone anywhere. And that is despite the prevalence of rand hedges in that index, like Richemont, for example, Nastassia process. So SA Inc. not having a good year, really. If we look at some of the frothy growth stocks, I think they've done better than I expected this year. So a nice example for South African investors is if you look at something like the Signia Fourth Industrial Revolution ETF, you know, that's a rand denominated way of looking at this, these global tech companies, and that's up around 22% this year. Around 12% of that is rand depreciation. So there has been a run in global growth stocks that has delivered the rest. But I think the one that has really surpassed my expectations, you know, I hoped it would do well because I own it in my tax-free savings account and outside of that, actually. And that is the One Invest S&P 500 Infotex Index Feeder ETF. It really rolls off the tongue. But luckily, it does reward you for holding it. It's up 57% this year. And why is that? It's because their biggest holdings are Microsoft, Apple, and Nvidia. So that is really where you wanted your money this year. And I think the surprise there has been the artificial intelligence hype, right? AI is what everyone is talking about, and it's been really driving those huge tech stocks in a big, big way. Things don't go up forever, of course. And Microsoft is one I'm watching pretty closely. It looks like it's working on a potential double top, which is a technical pattern that you have to be nervous of. But at the end of the day, who knows? You know, the US market, it's kind of hard to justify some of these valuations, and yet it just keeps on going.
So, I mean, what's quite interesting for me, especially when I look back at the week that was, I mean, if you had to pick two pieces of company news that stood out for you, which would it be? And I suppose why?
So it's been a bit of a quiet week, to be honest. Not a lot of earnings announcements and stuff going on this week. We're in a bit of a funny period right now. But the one I think that stood out for me was RCL Foods. They took a really big knock from a special sugar levy. The problem there is that Tongaat Hewlett in Business Rescue is not actually paying its sugar levies. So what happens is, you know, the way the sugar industry works, and I don't really know how it works, I found this very interesting, that's why it's on my list, is that the rest of the players in the industry then suffer because they raise a special levy that everyone else must pay. You know, it's like living in a complex and you want to do a nice project, but actually 3 of the units just refuse to pay. That's what's going on in the sugar industry right now. I didn't know that, so, you know, learned a lot from that. And then I think the other one that I found interesting was PBT Group. So that's a small cap that I like to keep an eye on. This business basically sells time at the end of the day. It's like a miniature Accenture in many ways. They've got consultants working on big data type projects for clients, etc. They've been doing incredibly well the past few years, but margins are finally starting to come under some pressure. Client budgets are not endless, even for stuff like big data. And of course, the staff have a rare skill and they want to be paid for it. So you end up with margins getting squeezed in the middle. So again, a good lesson in, you know, not everything can be great forever. Eventually, something somewhere starts to go a bit wrong.
The one piece of information, I suppose, company news that I found quite interesting, not because that they actually put out news, but due to how JP Morgan reacted to this particular company, and that's MultiChoice. We did see it down about 12% at some point. What are some of the challenges that MultiChoice is going through right now?
You know, it's enough to make me cry, right? Because JP Morgan's highlighted the stuff I've been writing about for 2 months, but sadly, I don't get to move the market down 12% like they do. They're highlighting much of the same stuff I'm highlighting, which is, you know, you've got a South African business that is not exactly high growth, let's be honest. You've got load shedding, which puts a lot of impact on people's spending. If your TV's off, it's a lot harder to justify having a DSTV account. Advertisers are then looking at this and going, why do I want to pay to be on TV? If the power's off, I can rather be on radio in people's cars, for example, or on billboards. You've got the problem of obviously the move to streaming. My worry for MultiChoice, it's a bit like Telkom. Telkom kept telling everyone, okay, we have these legacy businesses. They are slowly dying, but don't worry, guys, we have Telkom Mobile that'll pick up the slack. Telkom is dying a lot faster than it's growing. You can see it in the recent results. Change happens faster than a lot of these corporates would like us to believe. So that is my one concern for MultiChoice South Africa. The only reason they really still have a good business is because broadband access is unfortunately very limited in South Africa, which is a real pity. And then at group level, they are investing heavily in Africa because, again, they go where broadband access is fairly weak, right? So you can give people hours of entertainment on satellite for a relatively modest fee if you look at how many hours of entertainment you're getting. The economics change when you have broadband internet and you can just get Netflix. So they are investing heavily in Africa. They are also doing it in streaming. So that's the Showmax partnership with Comcast. That's very expensive. If you've ever looked at the early stage economics of something like Netflix, or even if you've gone and looked at Comcast, you can go see Peacock's results. They're not great. Streaming doesn't make money for quite a long time. So MultiChoice has got this South African business that is not exactly bulletproof, having to fund an enormous investment program at group level. It doesn't leave much left for shareholders right at the top in terms of dividends. So then they have to see MultiChoice as a growth company. That's a big ask. I'm not sure MultiChoice is a growth company, despite what they would have the world believe. And, you add all of this together, and sooner or later there's pressure on the share price.
Let's talk about South African banks. Are you seeing any value at this particular point, given that there are some analysts saying that endowment effect that we were seeing from higher interest rates might start coming to a close or beginning to run its course?
Yeah, so the analysts are basically quoting the banks verbatim. So a bunch of them have given recent guidance that basically suggests exactly that point. And what we are seeing is credit loss provisions are quite high in retail and business banking specifically. Corporate and investment banking, that's holding up a lot better. So the lesson here is, surprise, surprise, the biggest balance sheets, they are in the best shape. I mean, that's exactly what you would expect, right? And if you look at share prices year to date, Nedbank, Standard Bank up like low single digits. First Rand is at 8%. ABSA is lagging at 14% down. Capitec has hurt the most. It's down nearly 19%. The story is better for all the banks over 12 months, except for Capitec, in which case it's actually worse as that valuation unwinds. But the way this endowment is playing out, a lot of it is going to come down to what happens with load shedding and this mystical improvement that we've seen in recent weeks that no one really understands and even fewer people actually trust. But if that persists, then the economic situation will probably be better this year than the banks were expecting in their credit loss models when they gave that guidance. But at the end of the day, we do have a fairly high interest rate environment now, not higher than we've been at times before. It can still get a hell of a lot worse. But further rate increases are probably not going to be overly helpful for banks now. What they actually need is a steady period of the lights staying on, at least as much as they are now, while that higher endowment income and net interest margin actually runs for a few quarters. That's what they really need. Whether or not we'll get that environment, I don't know. The Fed is probably going to hike rates again this year, if not at the very next meeting. And it's likely that the SARB will have to follow that, and that probably won't help banks right now.